Bitcoin climbs to kick off the week after hitting a new all-time high above $125,000.
So Bitcoin breaking below 92K, down more than 27%.
A brutal month for Bitcoin, the digital asset plunging more than 30% from the all-time high it hit just last month.
The crypto market has been limping along since October 10th because on that date was a negative shock. I mean, today's stock market looks a lot like an echo of what happened October 10th.
Bitcoin has reached a historic new all-time high, marking one of the strongest rallies the crypto market has ever seen. But this time, the momentum isn't driven by hype or short-term speculation. It's driven by deep structural forces that are reshaping the market and creating a powerful foundation for long-term growth. Let's break down why Bitcoin is rising, how these forces interact, and what this means for what comes next. The first major driver is the surge in institutional demand through US spot Bitcoin ETFs. Since their launch on January 10th, these ETFs have attracted more than $12 billion in net inflows. Major issuers, BlackRock and Fidelity, account for nearly $7 billion of that total. This is strategic, long-term capital coming in from pension funds, wealth managers, and major institutions. This isn't retail noise, this is serious money. The second driver is the upcoming Bitcoin halving. In mid-April, the supply of new Bitcoin entering the market will be cut in half. With demand already at record levels, this creates a significant supply shock. Every halving has led to strong price performance in the months that follow. The third driver is the macroeconomic environment. The US economy is growing, inflation is cooling, and markets expect central banks to begin cutting interest rates soon. Lower interest rates are historically bullish for risk assets, and crypto often reacts even more strongly to these shifts. The fourth driver is momentum across the broader crypto market. Ethereum has 7 spot ETF applications awaiting approval, and its recent Dencun upgrade dramatically boosts network efficiency, opening the door to scaling solutions that could reach up to 100,000 transactions per second. This strengthens confidence across the entire digital asset ecosystem. The driver is regulatory clarity. New frameworks in the European Union through MiCA, along with evolving regulations in the United States, are providing the transparency institutions have been waiting for. Clear rules reduce uncertainty, lower volatility, and make crypto a more attractive asset class for large investors. These forces don't exist on their own, they reinforce each other. Every halving cycle has historically followed a familiar pattern: rising prices before the event, a short consolidation, and then a strong upward surge in the months that follow. Now, with ETFs inflows, these dynamics could be even more powerful. Institutional products are also transforming the market. Spot ETFs and upcoming futures-based ETFs are making Bitcoin easier to access, to integrate into traditional portfolios. That increases liquidity and brings in long-term, stable capital. At the same time, regulatory clarity is smoothing market volatility, which helps attract even more money. Put all of this together and the outlook becomes clear. Record demand, shrinking supply, a supportive macro environment, rapid technological progress, and clearer regulation all point towards sustained Bitcoin. As inflation cools and interest rate cuts begin, the environment becomes even more favorable. And with institutional adoption accelerating, the market is entering a new phase of maturity. In short, 5 structural drivers are helping form a strong foundation for Bitcoin and the broader crypto ecosystem, one that could support long-term growth well into the future. Thank you for watching. If you found this analysis helpful, be sure to like, subscribe, and stay tuned for more insights on the future of digital assets.